Hi, I'm James Robinson, and this is my stock pick of the week. This is my fourth and final video on the company RYAAY, symbol RYAAY. Usually I do a video on dividends, but RYAAY doesn't pay a dividend, and so I'm not doing that video. So this video is on wealth creation. By wealth creation, I mean the ability of management to use this company to create wealth for the shareholders. And so we'll talk during this video about what that means and about the job that RYAAY and the management is doing to enrich us. Management has several tools at their disposal that they can use to enrich shareholders. One of those tools is to rebuy shares, to repurchase shares. And that's something that the management of RYAAY has been doing for quite a while. In 2007, they reached the most amount of shares that they've possessed. Basically, you can see from this chart on the left here that the number of shares outstanding has gone from about 310 million to just under 230 million. That's fantastic. So this company has been every year buying back shares, which does enrich the shareholders. And one of the great things about buying back shares is it does it in a tax-free way. The way it enriches us is we own a larger percentage of the company without investing any money. In theory, that means we should own a larger percentage of the profits. It also means those profits are divided over a smaller number of shares. The earnings per share therefore goes up, and in theory, as the earnings per share goes up, the stock price should go up commensurately. So we like when companies do stock repurchases, and this company has been doing it consistently for a long period of time. It's not enough to just say they've been buying back shares. We need to do that in some sort of context. So the analysis that I always used is what would happen if you owned 10% of the shares 10 years ago? How would that have affected your ownership today as a result of them buying back shares? So if you owned 10% of RYAAY stock in 2009, you would have owned about 28.8 million shares. As a result of stock repurchases, your 28.8 million shares would mean that your ownership in the company has increased from 10% to 12.9%. So you'd own about 29% larger share of the company than you did 10 years ago, and that's without spending a penny of your own money. So that's obviously really, really good. That's a significant increase in the percentage of the company you owned. Even better, your share of the company earnings would have gone from $41 million, so that's 10% of the earnings that they had 10 years ago, to $92 million today. So that's fantastic. The earnings per share has gone from $1.44 per share to $3.22 per share. So that's because the earnings have effectively doubled, and the doubling in earnings is spread over 30% less shares. So that gives you a sense of how much repurchasing stock has enriched us, the shareholders, and it's fantastic. It's one of the reasons why I like this company, because even though it doesn't pay a dividend, the management is doing things that enrich us as shareholders. Another thing that happens that can increase the value of the company to us, the shareholders, what's happening with shareholder equity. So shareholder equity is simply the total amount of assets minus the total amount of debt. This company in 2001 had a shareholder's equity of, call it 750 million. Today, that shareholder's equity is, call it 5.5 billion. So that's a fantastic increase in shareholder equity. And in theory, in the long run, as shareholder equity increases, you would expect that the value of the company is increasing as well. And that's certainly what we've seen with RYAAY. So we like increases in shareholder equity, and this company's done a very good job of that. Another good thing about the company buying back shares is that the shareholder's equity per share has gone up disproportionately to the shareholder's equity. So shareholder's equity has gone up, but in the last 10 years, shareholder equity per share has gone up 30% faster because we bought back shares. And you can see that this is demonstrated here. We've gone from, $2 of shareholder equity in 2001 to $25 of shareholder equity, so 12 times. So we've done very, very well with shareholders' equity, and even better shareholders' equity per share as a result of all the stock repurchases that have happened. One of the things that I really look at a company is what kind of return on assets are we getting? Every company that makes money needs a certain amount of money to produce that money, right? So it takes money to make money. What the question is how much money does it take to make the money, and how much money you're making off the money that's invested? So we look at that as return on investment. I like to have companies that are very, very good at getting return on investment. That means that they're not capital intensive, or if they are capital intensive, they're doing a good job of taking that intense capital investment and returning it to us, the shareholders. And you can see that for a number of years, this company has been in the top 10% of companies in terms of return on assets. It hasn't done as well in the last 2 years. We've talked ad nauseum that there's been some things that have happened in this marketplace in the last 2 years that have justified that or that can explain that. I believe the return on investment that has dipped in the last couple of years is a short-term thing as a result of COVID, and that the economy for air travel is going to recover, and this company is going to go back to doing great things because they've been able to do it consistently. So just so you see, the red line would mean you're in the top 10% of companies that return on equity. The green line means that you're in the top 25% of companies that return on assets. And that's where I like to see my companies in terms of what I'm looking at investing. Return on shareholders' equity is the same analysis, but instead of using total assets, we use assets minus debt. I'm not as big a fan of return on equity because that rewards companies for having a lot of debt, and I don't like a lot of debt. So you'll often see companies that are very, very highly leveraged, which means they have a tremendous amount of debt relative to their assets. They're able to get fantastic returns on equity because they don't have very much equity. So any profits at all make it look really good. The problem is that when things go bad, all that debt tends to drag you down and tends to get really, really ugly very quickly, and you can get negative return on equity because you don't have any profits. So I don't look at this as important as a lot of other people do. This company's, again, traditionally been in the top 10% in that category, top 25% for many years as well. Not as important to me as return on assets, but still solid for this company. One of the ways that companies accumulate assets is through retained earnings. So what retained earnings means is the company turns a profit, but instead of giving that profit to the shareholders in one way or another, or reinvest, they have to reinvest it in the business. They have to, for in the case of an airline, they have to buy new airplanes, for example. And so that would be a retained earning. When companies have to retain tremendous amounts of earnings in order to stay profitable, that means that they don't have the ability to give that money back to us, the shareholders. So I don't like companies that retain a lot of earnings. And you can see that this company's been pretty good at in terms of keeping the retained earnings under control. When you look at how much they retained in earnings in 2007 versus 2018, for example, it didn't go up very much, especially when you look at how much profits went up over the same period of time. So again, ignoring what happened the last 2 years, if you look at Ryanair over a long period of time, they've done a great job of keeping the retained earnings to a minimum and returning money to the shareholders instead, or as a result of the fact they haven't had to invest as much money in retained earnings. More important than more important than retained earnings is the return on retained earnings. So this is an oversimplification. It's just giving me a guideline, but what I do is I look at how much money the company retained over a 10-year period of time, and then I look at how much the profits went up in that period of time, and I oversimplify things and say 100% of that increase in profits was a result of how efficiently they used the retained earnings. I realize that's an oversimplification. I realize there could be lots of reasons why they made money and that they could be tremendously inefficient in retaining their earnings. But I'm just looking for some measure to see how well they do. And I look at any company that's able to get a 10% of return on retained earnings as a company that I don't mind them retaining earnings. And you can see that this company has been north of that basically for their entire history. Even the last couple of years, as things haven't been good, they've still managed to get significant returns on retained earnings. So that's something that's very important to me. I don't mind if a company needs more and more cash to become more and more profitable. What I hate is when a company needs more and more cash to maintain the same level of profit. That means that the business is inefficient at the way they use our capital. And again, as a shareholder, that's our capital, and any money that they're not putting in the business is money they could give back to me. Any money they are putting in the business is money they can't give back to me. And so I mark down when they don't do a good job of creating profits through retained earnings. I don't look at cash necessarily as a benefit that the company is retaining a bunch of cash. But one of the things that a company can do with their profits is keep it in cash. And when they have that money in cash, that's money that they have for a rainy day. It's money that they don't need to borrow in bad times. It's money that they can use to buy new equipment. It's money they can use to buy new assets if they come on the marketplace, whether that be new subsidiaries or new routes or whatever it might be. So I give companies credit for accumulating cash. At some point, there's too much cash and they should be figuring a way to give that back to the shareholders. But I don't look at that in the wealth creation phase. I look at that in other phases of the business. In this thing, I do give companies full credit for retaining cash. And you can see that, Ryanair did a great job. They went from, a few $100 million in cash to almost $4.5 billion in cash in 2015. And more importantly, since 2015, they've gradually been giving that back. They've gradually been reducing it, which tells me there's a point at which they feel they have enough cash, and they're comfortable giving it back to us, the shareholders. So that's a look at the cash and why I think that's important when we're looking at wealth creation. Looking, sort of putting a bow on all of this, there are a number of things that a company can do with their profits. They can reduce debt, they can pay dividends, they can buy back stock, they can increase cash. And so here what I've done is I've just charted what happened with each of those categories. And then I've said cumulatively over the last 5 years, what's the net result of that? And you can see that since about 2010, the cumulative amount of all that is they've benefited. They've either bought back enough, they never paid a dividend. So they bought back enough stock, they've increased their cash and paid down a debt enough that it's resulted in this net gain to us, the shareholders, which I call wealth created to the shareholders. And it's my opinion that if a company is consistently doing this, that in the long run, that's going to really benefit the shareholders. It's not scientific. It's more just sort of it gives me a sense of what the management's doing. And, in this case, again, I see that it's doing great. One of the things that you'll see is that the cumulative wealth created over the last 4 or 5 years has been decreasing. That's okay because the company's getting bigger and bigger and it's harder and harder to create these outsized returns. But long story short, it's still very positive. So that sort of does it for RYAAY. We've talked about the company's overview. It's an airline. We've talked about the problems that the airline industry has in terms of operations for the last 2 years, why I believe that that's a short-term problem, why I believe it's going to come back. We've talked about the company's debt, which I think is in line with its operations, and now we've talked about wealth creation. So long story short, I'm very bullish on RYAAY. I think it's going to be a great stock for us in the intermediate and long term, or I guess probably the short term and intermediate term. In the long term, I'm not sure I'm going to be a long-term 5 or 10 year buyer because I think the airline business is very cyclical. But for where we are right now, I like buying it at this price, and at some point I'll probably sell it. The last slide that I always do in wealth creation is look at our current portfolio and where it is. Just to give you a sense, every stock here that I've owned is a stock that I've done an analysis on, that I have bought at some price and held for some period of time. So you can see here the date I purchased it, if I sold it, which the only stock I've sold so far this year is Intel. So you see the date that I purchased it, the date that I sold it, how many days I've owned it. You can see that my average hold time so far for all of my stocks is about 225 days. About 7 or 8 companies I've owned for over a year. A lot of these companies I bought sort of as the recovery was happening from COVID as the economy bounced back. So you can see that I own several stocks in multiple places. That means I bought it at one point and then came back and bought it again. Again, I haven't been a big seller of stocks. Some of these stocks I've got significant profits in and I might sell. Some of them I'm waiting till I've owned it for a year, and that way I can sell it for a long-term capital gain versus a short-term capital gain in America that gives me some tax advantages. But long story short, I'm outproducing the S&P 500 by about 5%, getting nice dividends on my stocks. Don't have a lot of cash right now. I'm down to about $7,000 cash on my portfolio, which is just under $200,000. And in fact, this is a little bit outdated because I bought a stock today called Graham Holdings. And so that will be reflected in the next video. I just haven't gotten around to it. But long story short, this is great. If you look at these, my returns have been really, really good on all of these stocks, both this year and since I bought it. I think I have 2 stocks in the red. Everything else is in the black. Really excited. Things are really good. I know the market's red hot. But having said all that, I've done the math. My average PE ratio for all of my holdings is about 20%. About 20 times earnings. So my particular stocks aren't tremendously overvalued relative to the S&P 500. So I think we're in good shape. I'm really happy about the portfolio. I'm happy about what's happening. Thank you very much for watching, and I'll talk to you soon.